The update. Well, let's get straight to Roger Montgomery, an independent strategist for RogerMontgomery.com, joining me now live here on set in Sydney. Roger, it's good to have you back with us.
It's nice to be back.
Look, let me ask first of all about these GDP numbers, what they mean to you as, of course, an investor in this market.
20 years ago or 30 years ago, if there was a big surge in capital expenditure, then you'd expect it to be followed by a significant employment growth. But today, it's very different. Technology is replacing labour, and so a lot of the CapEx spending, if it's not related to resources where there's already a labour shortage anyway, so you wouldn't expect that massive surge in employment, it's already tight, is high technology expenditure, and so that's generally used to replace labour, so you don't get that follow through in the labour and in employment. So I'm often very cautious about how bullish it is, the capital expenditure, because it may actually not be followed by a big surge in employment.
What does that mean overall then? You're more cautious than...
As you know, I don't really concern myself too much with every single number that comes out on a monthly basis. I'm more interested in what a company is going to look like in 5 or 10 years from now. But generally, companies are driven by increasing, they're trying to increase their profits, they're trying to improve their margins. So capital expenditure, as we go down the technology track, replaces labour in a lot of cases and replaces people and becomes more efficient. So you get higher productivity for existing labour because you're imposing new technology on them to use.
Is that the theme that you're really following, or you're looking for specifically when it comes to companies? Because Australia, we know it's a resource-heavy market. It certainly isn't an IT-heavy market.
Well, that's exactly right. Unfortunately, another theme that's of interest to me is whether or not we can actually sustain an economy that doesn't have resources and it doesn't have manufacturing when this boom eventually does bust, and it will ultimately. We don't know when, of course, and I don't know the magnitude of any rally before that. But ultimately, when that's gone, what do we have? Do we have a service industry? Well, I don't know that we're going to be a financial hub. Singapore provides a $300,000 for 3-year tax-free zone if you're a new business. Australia doesn't do that. Tax rates over there 15%, over here significantly higher. We're not going to be a financial hub. We won't have resources. Eventually that will dissipate. We may have agriculture. That would be good, provided we don't sell all of it. And we're only at the cusp of a food crisis, I think, globally. And then of course, so if we've got agriculture but no resources, no financial services of any global repute, it's small, it's niche. What are we going to do? Run around serving lattes to each other? There's really not a lot left. Manufacturing's gone.
You're not making me feel very good about being in Australia right now, Roger.
Let me say this.
Give me something good, please.
Within that story, within those longer-term stories, and they're not the only ones. I've just put something up on the blog now about the declining imperialism of the United States as well, and that's something that's very interesting. But within that, I look at individual companies, so I'm not really trying to forecast any of the things that I've just talked about. I'm more interested in what are the good businesses, given this sort of framework that we exist in, which are the businesses that are going to win. And there are some that are going to do very well for a short time, there are others that are going to do very well for a long time. And my job's to find those that are going to do well and buy them at a cheap price.
Talk to me about the ones you found.
Well, look, the right question to ask any broker or advisor if you're an investor is not where's good now. The right question is where's most miserable now. And there's 2 places that I think are miserable at the moment to varying degrees. The first one is retail. You've got high saving rates at the moment. People aren't spending. I just had a coffee with someone from American Express, and they were telling me that that restaurants are doing quite well, but retail is, particularly fashion retail, is not going very well. And they get to see, as you can imagine, they get to pass all the data all different ways. It's very, very interesting. So retail's not going well, and within that space, in addition to the fact that people aren't spending money, in addition to the fact that they're saving more, in addition to the fact that they're spending overseas online, in addition to all of that, you've also got the banks coming out and saying, well, we're not able to increase credit. People aren't borrowing money to buy stuff. So it's not just the small items they're not spending money on, they're not spending money on the big items.
So as a result, are you avoiding retailers or are you buying
retailers? No, this is precisely the place to be looking for value.
Are they cheap enough?
Well, some of them are, and what's interesting is JB Hi-Fi, which we've talked about for a long time, it's dropped a lot in price. Now, why has that happened? Well, the company just announced a buyback. They bought back 10 million shares. They've reduced their shares on issue from 108 million shares to 98 million shares. The best thing a company can do when its shares are trading at a big discount to their intrinsic value, the most rewarding thing they could do for shareholders is to repurchase shares. JB Hi-Fi has done that. A lot of fund managers, a lot of guys like me, have missed out on the buyback. They bought shares come the buyback. They missed out because there was a huge scale back, so they're caught long the stock and they're selling it and the share price is dropping. But the intrinsic value of JB Hi-Fi has actually gone up as a result of the buyback.
Yeah, and shows confidence, doesn't it, in the long-term growth prospects for the company as well.
Well, look, I was just going to say, a certain portion of retail spending will go online, but it won't all be online.
Yeah, there has to be still, of course, people in the shops here on the ground. Thank you so much for joining us.
It's a pleasure.
Always a pleasure to have you with us, Roger.
Thank you again.
Roger Montgomery from RogerMontgomery.com.